How well do you really understand invoices? Let's find out. I'm James, you're watching Accounting Stuff, and today I've meticulously prepared 20 multiple choice questions for you. So without further ado, let's begin. This video is sponsored by QuickBooks Online. Question 1. What is the main purpose of a traditional invoice? Is it to provide a price estimate before work begins, to confirm the delivery of goods, to request payment for goods or services provided, or to record internal business expenses? The answer is C. An invoice is a request for payment. It also acts as an official record of the sale. Question 2. What does PO stand for? Is it payment order, project outline, purchasing officer, or purchase order? It's D. PO is the initialism for purchase order. Question 3. Which of the following is not typically included on a quote? Is it a price estimate, a description of goods or services, a payment received confirmation, or a validity period or expiry date? It's C. A quote outlines the estimated price and details of goods or services to be supplied, often with an expiry date. Question 4. Who usually issues an invoice? Is it the buyer or the seller? It's B. The seller issues an invoice to request payment for goods or services supplied. Question 5. Who usually issues a purchase order? Is it the buyer or the seller? The answer is A. The buyer issues a purchase order to request goods or services at agreed prices and terms. Question 6. Who usually issues a receipt? Is it the buyer or the seller? That would be B. The seller issues a receipt to confirm that the payment has been received. Question 7. What is the typical order of the sales process? Does it go PO, quote, invoice, payment, receipt, quote, invoice, PO, receipt, payment, quote, PO, invoice, payment, receipt, or invoice, payment, quote, PO, receipt? It's C. The seller provides a quote, the buyer sends a purchase order, the seller issues an invoice, which the buyer pays, and then the seller provides a receipt. Before we get into question 8, I want to mention today's sponsor, QuickBooks Online. One of the biggest challenges in the sales process is getting paid accurately and on time. When you're sending out lots of invoices, it's easy for things to slip through the cracks, and that can hurt your cash flow. But QuickBooks Online has your back. From a seller's point of view, QuickBooks makes it simple to create and send invoices and quotes. You can track their status in a colourful dashboard and send reminders for overdue invoices to keep that cash coming in. And from a buyer's perspective, QuickBooks lets you create purchase orders and record incoming bills, so you always know exactly what you owe at any given moment. You can try out QuickBooks Online today using my link in the description to get the latest discount or a free trial. Thanks to QuickBooks for sponsoring this video and for supporting my work. Question 8. Why do invoices have invoice numbers? Is it to calculate the tax on the invoice, to uniquely identify the invoice for record keeping, to show the customer's payment history, or to confirm that the goods were delivered? It's B. An invoice number uniquely identifies an invoice, so it can be tracked and referenced in accounting records. Question 9. Net 7, Net 30, and EOM are all types of delivery schedules, billing codes, tax codes, or payment terms. It's D. Payment terms set out when a customer is expected to pay for goods or services. Question 10. Net 30 means the invoice is due 30 minutes after it's sent, 30 days after the invoice date, 30 days after the goods or services are delivered, or on the 30th day of the month. It's B. Net 30 means the customer has 30 days from the invoice date to pay. Question 11. What does EOM stand for? Is it end of month, end of margin, end of monitoring, or end of measurement? It's A. EOM stands for end of month. Question 12. When a business issues a sales invoice to a customer, which account increases? Is it inventory, expenses, accounts payable, or accounts receivable? It's D. Issuing a sales invoice increases accounts receivable because the customer now owes the business money. Question 13. When a business issues a payment for a supplier invoice, which account decreases? Is it inventory, expenses, accounts payable, or accounts receivable? It's C. Paying a supplier invoice decreases accounts payable because the business no longer owes that amount to the supplier. It also decreases cash. Question 14. What's the main purpose of a credit note? Is it to request payment from a customer, to confirm that goods have been delivered, to reduce the amount a customer owes, or to record a new sale? C again. A credit note reduces what a customer owes. Question 15. Which of the following is not a valid reason to issue a credit note? That the customer paid earlier than expected, that the customer was overcharged, goods were returned or damaged, or the wrong quantity was invoiced. It's A. Paying early doesn't justify a credit note. Credit notes are issued for returns, refunds, or errors. Question 16. A customer issues a partial payment for a sales invoice. How does this impact accounts receivable? It increases, it decreases by the amount paid, it's fully cleared, or it's unaffected until the full payment is received. It's B. A partial payment reduces accounts receivable by the amount paid, and the remaining balance is left outstanding. Question 17. A business issues a sales invoice for work completed this month, but the customer will pay next month. Under accrual accounting, when should the revenue be recognized? Is it when the customer pays, when the work is completed, when the invoice is recorded in the accounting system, or is it at the end of the tax year? B again. In accrual accounting, revenue is recognized as it's earned, not when cash is received. This is called the revenue recognition principle. Question 18. A business receives a supplier invoice for services received the previous month, but will pay the supplier next month. Under accrual accounting, when should the expense be recorded? Is it when the supplier issues the invoice, when the business receives the invoice, when the business pays the supplier, or when the services were received? It's D. Under accrual accounting, expenses are recorded as they are incurred, not when cash is paid out. Question 19. A business accidentally overcharges a customer on a sales invoice due to a pricing error. What should they do to correct it? Should they ignore it, ask the customer to fix it on their end, issue a credit note and send a corrected invoice, or wait until the payment arrives to make adjustments? It's C. They should issue a credit note to reverse the incorrect amount and then send a corrected invoice. Question 20. A business accidentally enters a supplier invoice twice in its accounting system. What problem does this create? Accounts receivable is understated, accounts receivable is overstated, accounts payable is understated, or accounts payable is overstated? The answer is D. Recording a supplier invoice twice overstates accounts payable because the business appears to owe more than it actually does. To correct the error, the duplicate invoice should be voided or deleted. Bonus question. Which two documents are commonly matched before approving a payment on a supplier invoice? Is it the purchase order and invoice, the quote and receipt, the invoice and bank statement, or the receipt and credit note? It's A. Matching the purchase order to the supplier's invoice confirms that the business is only paying for goods or services that it actually ordered. This is an important control that helps prevent overpayments and fraud. How many did you get right? I'd love to hear how you went, so please drop your score down in the comments. If you'd like to give QuickBooks a try, you can sign up using my affiliate link. I'll leave that in the description too. And if you want to practice some more, you can find my full accounting quiz playlist right here. See you soon.